Is the stock market party ready to end? Well, day in and day out, we hear the perma-bears telling us it's over, run away and buy gold. And the perma-bulls saying, well, stay on course, we're going for new heights. The question, of course, for you to answer is, who's right? Welcome to this Safe Insight, where we're going to shed some light on this all-important question. Now, let's understand at the outset that no one, and I mean no one, has the perfect crystal ball. We can all connect dots to build a very strong story for one side or another, but in the end, the only perfect foresight we know is after the fact. So with that said, however, there are some key fundamentals you can understand and use to determine how much you want to invest in the market. A key ratio often looked at is the price-to-earnings ratio, or PE. This simple little measure reflects the amount of money, the price, that you are willing to pay for $1 of earnings. It also serves as what's called the earnings yield by simply making the equation E over P, or inverting it. And that's how much earnings do you get for each dollar spent. Now, historically, people have been willing to pay higher prices for earnings based on liquidity, growth prospects, stability, and other factors. For example, it was long held in the private market that a buyer of a company should try to pay no more than 3 times earnings for the target, meaning that the buyer could expect to get their money back in just 3 years. Now, the public markets have traded on average at about 8 times, meaning that investors would get their money back in 8 years, and that's largely because of the additional liquidity. Well, okay, here's where today's market gets a little scary. Based on what's known as the Shiller PE, that's a number designed by a professor at Yale University, the current buyers of the market today are paying a staggering 27 times earnings. In short, they won't earn their money back for 27 years. Now that's a healthy multiple. Another way to look at this, though, as I said earlier, is the inverse, or the earnings yield. At 27 times earnings, investors are earning a theoretical 3.7% on their money. Now, understanding that bonds are paying below that, well, perhaps it's not a bad investment, especially if you're in dividend-paying stocks. However, you should be monitoring very carefully because, as many people expect, interest rates could rise in the near term, and that would make bonds much more competitive, leading to money coming out of the market and an end to this market's expansion. The key observation, of course, is that you should be paying attention to your investments. Just because you're in a mutual fund or an exchange-traded fund or some other derivative instrument does not mean that you're not exposed to market risks. And to that point, remember that the first rule of investing is not to lose.